Top mistakes in direct investing. In this video, we will discuss some of the most common mistakes investors make when investing directly in private companies. If you have watched some of the other videos on this site on direct investing, you may have noticed several of these issues brought up, sometimes more than once. Top mistake number 1, not being diligent in your due diligence. Entrepreneurs, almost by definition, are optimistic. They believe they can accomplish great things with limited resources, and amazing things with ample resources. Most entrepreneurs are also good, honest people with pure intentions. They are not trying to deceive you or trick you into investing in their company. Having said that, part of your job is to temper their enthusiasm and optimism with an independent assessment of the realities they face. What is the process you use to hire a new employee? First, you look at their resume, then you meet with them, and then you, hopefully, do a reference check and perhaps even a full background check if they are in a position to handle money. All too often, many investors don't perform even the simple steps to validate an entrepreneur's claims. But you also have to look at the company, its products or services, and how it operates now and will operate in the future, and also its competitors. You have to also fully analyze the financial projections. While the projections may not look anything like the actual numbers the company will see over time, you have to see if the projections make sense. Let's look at some examples. Revenue/income. Sales. Do the sales projections make sense? Is there any logic behind them, or are they based on an arbitrary goal of 1% or 10% of the market? Is there any logic driving rapid revenue growth? What creates the inflection point in that quote-unquote hockey stick, and what is a key driver that fuels a revenue rocket thereafter? Does the sales cycle match the product or service with the customer? A $100,000 widget longer to sell than a $1 widget. Selling to individual consumers may take less than an hour, but selling to Fortune 100 companies or the government may take years. Does the pricing make sense? Would the target market pay that price for what the company offers? How does this price compare to competitors' pricing? Let's look at expenses. One of the biggest line items is usually salaries. Is the management team expecting to earn $100,000 or more even before revenues? If so, they may not have the motivation to grow the company for an eventual sale. Also, cross-check this with their resumes. A relatively junior person who founds a company and then expects to be paid like a CEO reeks of inexperience that may come back to bite you later. Conversely, if an experienced team, people with mortgages and families, especially those with a spouse who is not working, don't include some salary for 3 or 4 years, may find themselves in a dire personal financial situation, or divorce, that can derail a promising company. Do they have enough salespeople to achieve the sales projections? Do they have enough people in research and development to make enough of the new product to sell according to the projections? Marketing. Quite simply, first mover advantage is costly. Any company that expects to sell something radically new and different to a big market should include a substantial marketing budget. Support. Again, anything that is radically new is going to cause a lot of people to have questions or worse returns. Companies need a budget for customer support and/or technical support. One of the more common mistakes entrepreneurs make is believing that they have no competition. Likewise, investors who believe this are making a mistake as well. Often just a 5-minute web search can reveal significant competition. Investors need to understand the real threat and the opportunity in the marketplace. There is a real dilemma for direct investors. Almost every deal has something wrong with it. The one exception is a deal that sounds too good to be true, which means it probably is. So, you can always find a reason to say no. Even companies like Google, Amazon, and Netscape had more investors say no to the deal than yes. On the other hand, you will need to say yes enough times to create a portfolio. The key is to look at a lot of deals until you find one that you are comfortable with. You may have to look at 50 to 100 deals for every one investment you make. Top mistake number 2, not anticipating future rounds. Can the company reach its goals, follow the hockey stick, without further outside investments? Experienced investors use the adage, it always takes twice as long and costs twice as much as you expect. If this proves to be true, could the company still survive, let alone grow exponentially, without at least another cash infusion? If the company was not anticipating future investment rounds, the first line of defense, if you will, is to turn to you and the other current investors. We'll talk about this in a bit, but what if the company needs to raise millions of dollars from VC or PE firms? As we explained in another video, sometimes the deal you sign can ruin the deal for later investors. There are a number of ways to do this, but perhaps the most common is agreeing to too high of a valuation. As a result, two things may happen. 1. Later investors will simply decline to invest in an overpriced deal. Or 2. They will only invest if the company agrees to a lower valuation. This will cause you to lose a portion of the company you thought you owned. This is called dilution. This same mistake can also cost you if you invest in convertible notes. A convertible note is a debt that converts to equity at some point in the future, usually upon a subsequent round of funding. Some call it a bridge note because the company raises just enough money to take the company over the chasm to the next round of funding, and the note is thus connected on both sides to both rounds. On the far side, at the next round, the note converts to equity at some discount, giving the note holders a bonus for their efforts. Unfortunately, if there is no future round of funding, the bridge turns into a pier. Your loan never converts, and you don't have the opportunity to see a large return. You also can lose on the other extreme, when the next round is very exciting. If the company sees a huge jump in value before the next round, your discount or bonus may be far less had you invested equity instead. Top mistake number 3. Not understanding the exit before you enter. Looking even farther into the future, beyond just the next round or two, you need to look all the way to the end of your investment in the company. Given the inherent risk associated with direct investing, you need to expect an unhealthy percent of your investments will fail. In fact, you may find that you need one home run out of every 10 investments to make up for the losses or mediocre returns on the other 9 investments. So, the home run needs to be big enough to carry the make of your portfolio to have suitable returns. Let's look at it mathematically. Let's say you want the direct investing portfolio to generate an annual rate of return of 12% over a period of 10 years. This is about the same as your expected returns on the stock market, so this should be a minimum expectation for you. You can't have a much shorter time horizon because direct investments are not very liquid, and it may take 5 to 7 years to realize a gain or a loss from any single investment. In fact, it can take much longer. But let's stick with 12% over 10 years. This means that over 10 years, growing at 12% per year, your money will triple. A portfolio of $10 million will thus grow to $30 million. Now, let's say you invest in 10 companies over this period. 10 million divided by 10 companies each equals $1 million each. So 10 investments of $1 million each. Now here's the problem. Because they are so risky, 9 of those 10 may not generate much return. Your one winner will have to make up the difference. In other words, one of your $1 million investments will need to generate the entire $30 million in return to make your portfolio hit your goal. That means that one home run needs to return 30x, or 30 times the original $1 million investment. That is entirely possible with direct investments, but only if you are looking at opportunities with this growth potential. Of course, the other problem is that you don't know in advance which of the 10 investments will be the one. If you did, why invest in the other 9? So you need to look at every deal with a skeptical, or some say ambitious eye. Can this company grow to 30 times its current size? One other note. If your goal is not a 12% return, but say 20% per year, your portfolio would grow 6 times and your one home run would have to be a 60 times return. This is why angel investors and venture capital firms that invest at least $1 million in each company aim for companies that can be acquired for $100 million or more to go public. The actual benchmark for your expected exit will vary based on the size of your investments. Whatever the number, if you are looking at companies without much growth potential, you may never realize substantial returns on your portfolio. Top mistake number 4, overzealous negotiations. Many entrepreneurs start their own company because they want to be their own boss. How ironic is it that raising investment capital is much like looking for a job? When someone is looking to be hired, one of the key discussion points is salary. As the boss, you would need to offer a compensation package that balances two conflicting perspectives. On the one hand, you have to be fiscally responsible with the company's budget. You can't pay them too much. On the other hand, you want to pay them enough to keep them motivated. The same dynamic comes into play during negotiations between an entrepreneur and the investor. Take pre-money valuation. If you, as the investor, agree to too high a valuation, you will certainly be losing out on potential gains down the line. But even ignoring mistake number 2 discussed earlier, for a given investment amount, say of $1 million, how much of the company you own is determined by how valuable the company is. So, if it is valued at $3 million before you invest, you would own 25% or 1/4 of the company after you invest your $1 million. However, if it is only valuated at $2 million before you invest, you would then own a 33% or 1/3 of the company. Should that company later be sold for $100 million, the difference is the difference between $33 million and $25 million or $8 million. As a family office, could you explain to your clients why you didn't fight harder for $8 million? That's one side of the story. If you push too hard on the entrepreneur and agree on a lower valuation, they may decide working 80-hour weeks isn't worth it if they don't stand to gain very much in a potential sale 5 years from now. They'll either decline your investment and you may miss out on a great opportunity, or worse, they may acquiesce and get burned out in a few years and not push the company forward fast enough to capitalize on the opportunity. The company will never generate large returns or simply languish in a state of marginal profitability. Top mistake number 5, not saving dry powder. In a previous video, we introduced the notion of investing in tranches. Instead of investing $3 million all at once, you can make 3 separate investments of $1 million over time. This strategy can limit your losses and provide measurable motivation for the company to hit the milestones you jointly lay out. However, investors who go all in immediately expose themselves to a common scenario where the company needs more money anyway and expects you to cough up more dough. If you hadn't planned on it and held money in reserve, the company may run out of cash, resulting in a total loss for you or in a state of desperation turned to new investors. Unfortunately, the golden rule of investing is, he who has the gold rules. Your investment may get diluted or some of the preferences you had negotiated may be taken away to make more room for the new investors. Top mistake number 6, pouring good money in after the bad. This is obviously related to the previous mistake regarding dry powder. If you plan on investing additional money into the companies in which you have already invested, you need to look at each distinct investment with fresh eyes. If the company is hitting their milestones and growing well, then you may want to continue backing this winning horse. But too often the fallacy of sunk cost causes even smart investors to keep investing in companies that should not be funded. What does that mean? If you've already invested or sunk $1 million into a company, it is hard to walk away from that earlier investment, even if the company is well underperforming. If you don't invest another $1 million, you'll lose $1 million. They just need more time. So you invest another $1 million to preserve the first $1 million. Now you have $2 million invested in a company that is still struggling to survive. Do you invest another $1 million, or do you walk away from $2 million? In hindsight, you could have walked away from the previous round and saved $1 million. Yes, you still could lose the first $1 million, but you could save the other $2 million to invest in different companies. As hard as it may be, you have to ask yourself, if I were just coming into this deal now, for the first time, would I invest given what I know? Another question to ask yourself may be, would I recommend a friend to invest in this company at this point? Top mistake number 7, not having an attorney to review everything before you sign it. This is pretty self-explanatory, very important, and so simple to do, we won't waste your time with discussing it further. To review the top 7 mistakes direct investors make, they are: not being diligent in your due diligence, not anticipating future rounds, not understanding the exit before you enter, overzealous negotiations, not saving dry powder, pouring good money in after the bad, and not having an attorney review everything before you sign it. For more information about ways to avoid these mistakes, please watch our other videos.